Hey there, and welcome. Have you ever looked at a business and wondered what its real financial story is? It's not all just about how much money comes in. A huge piece of the puzzle is how that money gets spent, and it all starts with one pretty simple question. Let's get into it. So just imagine for a second, you run a bakery. You need a massive oven to bake your bread, and of course, you need flour to make the dough. You're spending money on both. But are they really the same kind of purchase in the eyes of the business? Well, the answer is a definite no. And figuring out why is exactly what we're going to unpack here. You see, that oven and that bag of flour, they tell two completely different stories. One is all about investing in where the company is going, building for the long haul. The other, that's just the cost of keeping the lights on and the doors open today. Let's head back to our bakery. That brand new top-of-the-line oven, that's your future, right? It's going to be baking thousands of loaves for years and years. But that bag of flour, that's for this morning's batch of croissants. Poof, it's used up and gone. And that right there is the fundamental difference we're diving into. All right, let's put some official names on these things so we sound like we know what we're talking about. That big purchase, the oven, is what accountants call a capital expenditure, or CapEx for short. And all those daily running costs, like our flour, are called revenue expenditures. So what do these fancy terms actually mean? So a capital expenditure, or CapEx, is a pretty big deal. It's when a business spends money on something major that's going to provide value for a long time. We're talking more than just 1 year. Think of it this way. It's a purchase that boosts your power to make money, like a new delivery truck, a piece of factory equipment, or even the building itself. It's the foundation. Revenue expenditures, on the other hand, are all about the here and now. There are the everyday costs you have to pay just to keep the business running. We're talking about stuff like salaries, rent, the electricity bill, and, you guessed it, buying that flour. They get used up really quickly, and they're tied directly to the money you're making day to day. Okay, this slide right here, it really lays it all out perfectly. Just look at the purpose. CapEx is about beefing up your earning power for the future, while Revenue X is just about maintaining things today. The benefit from CapEx is long-term. For Revenue X, it's pretty much immediate. And here's the real kicker for the accountants. CapEx shows up on the balance sheet as an asset, something the company owns. Revenue X, that goes straight to the profit and loss statement as a cost that gets deducted right away. All right, so we've made our big purchase. Our shiny new oven is a long-term asset sitting proudly on the balance sheet. But what happens next? I mean, that oven isn't going to stay brand new forever, is it? Of course not. And we need a way to account for that. You know how it goes. After years of hard work, baking thousands upon thousands of loaves of bread, our awesome oven is going to start showing its age. It'll get a little worn down, maybe it won't be as efficient, and a newer, fancier model will probably hit the market. Its value just fades. It's a fact of life for pretty much every major asset a business owns. And this whole process of fading value has a name: depreciation. It's really just an accounting method for spreading out the cost of an asset over the time you expect to use it. Think of it as recognizing how much of the asset's value you've used up each year. Now, the key thing to remember is that it's a non-cash expense. No money is actually leaving your bank account. You're just making a note on the books that your asset is worth a little bit less now. So why does this even happen? Well, this slide shows us the 4 main culprits. First, you've got simple wear and tear, just from using the thing. Second is what's called efflux of time. Basically, things just get old. Third, and this is a huge one, especially with tech, is obsolescence. That's when something newer and way better comes along and makes your old model feel like a dinosaur. And finally, you have plain old bad luck, accidents. But wait, here's a really fascinating exception to the rule. Almost every physical asset you can think of depreciates, except for one big one: land. Because land, well, it doesn't really get used up, and it has a pretty much unlimited lifespan. So you don't depreciate it. In fact, it usually does the exact opposite. It appreciates, meaning its value goes up over time. So if we know our oven is slowly losing its value, how do we actually put a number on it? This isn't just guesswork. Accountants need a system. It has to be methodical. So let's take a look at how it's actually done. To figure out depreciation, you basically need 3 key pieces of info. First, what did the asset cost you in the first place, the whole shebang? Second, what's its estimated useful life? In other words, how many years do you realistically think you'll get out of it? And third, what's its estimated scrap value? What do you think you could sell it for at the very end, for parts or scrap metal? Now, the most popular way to calculate this is called the straight line method. And honestly, it's beautifully simple. You just take the original cost, then you subtract what you think the scrap value will be. That gives you the total amount that's going to be depreciated. Then you just divide that number by how many years you'll use it. And boom, you get the same steady depreciation expense every single year. Let's make this super clear with a real example. Let's say we have a machine that costs 200,000 rupees. We figure it'll last for about 8 years. And at the end of that, we can probably sell it for scrap for about 40,000. So we take the cost, 200,000, subtract the scrap value, 40,000, which leaves us with 160,000. We divide that by its 8-year life, and we get our annual depreciation expense of 20,000 rupees. Simple as that. Okay, so we've separated our big costs from our daily costs. We're carefully tracking how our assets lose value over time, but why? Why go through all this trouble? What's the big payoff here? Well, it all comes down to honesty and smart planning. So why is this so important? There are 3 huge reasons. First, it helps you figure out your real profits. By accounting for the cost of using your oven, you get a much truer picture. Second, it lets you show an accurate financial position. It tells investors and banks what your assets are actually worth today, not what you paid for them years ago. And third, and this is really smart, it acts as a plan. It helps the company set aside funds so that when it's finally time to replace that old oven, the money is there. At the end of the day, getting a handle on these ideas is about more than just following accounting rules. It's about being able to read the true story of a business. Depreciation isn't just some number on a spreadsheet. It's the financial story of an asset's journey, from brand new and valuable to old and ready for retirement. And more importantly, it's the company's plan to make sure its future is secure. So what story are your assets telling?